Hey. Hi guys, and welcome to Macro Markets. This is Marcel Pechman, veteran stock market trader and analyst and writer at Cointelegraph. Today is Friday, May 12th, and we'll be analyzing how the macroeconomic news and events impact the crypto trading. We'll start by discussing the economic crisis in Argentina, a Latin America country that is currently experiencing hyperinflation. Bloomberg reports Argentina is going broke to stall a full-on currency collapse. The South American nation has already spent all of its liquid international reserves, plus another estimated $1 billion, according to Buenos Aires consulting firm. So what's happening in Argentina? After years of populist measures, its local currency, the Argentine peso, saw its value go down by 70% in 2 years. The government overspending caused another issue, the lack of US dollars for the government and companies to pay for imports and remittances. Yes, believe it or not, the country has $1 billion in excess liabilities in comparison to its holdings, which include less liquid assets such as credit swap lines with China and foreign institutions. The government tried a desperate measure by intervening in the FX market, selling some $470 million just over the last week. But the strategy has utterly failed as families and companies are hungry, are desperate for foreign currencies. The solution has been a couple of emergency agreements and credit lines with China and Brazil, besides lateral agreements to bypass the payments in US dollars. It is worth noting that this is not their first or second rodeo with hyperinflation and risk of default. The population saw their savings frozen by the government in 2001, so they were quick to withdraw over $1 billion from the banking system just last month. In essence, the country is juggling with its financial obligations, and there are strong indications that the government has already illegally taken some of the US dollar deposits in the banks from companies and families. Okay, so there's a good chance that Argentina, home for 47 million people, to face a full-on currency collapse. But what does that mean for the US dollar, Bitcoin, and gold? Well, for those that are living in countries that have not experienced hyperinflation in the past 30 years, it might be hard to grasp the importance of saving in hard assets. However, that has not been the case for Iran, Lebanon, Turkey, Venezuela, Zimbabwe, Haiti, and so many others. With no doubt, gold could work as a store of value, but it poses two problems for citizens of turbulent economic regions. Number one, there is no easy way to ensure whether or not the precious metal is fake. Number two, it doesn't actually work for international remittances. So dollars and euros are the preferred savings and means of exchange for those facing a weak domestic currency. However, in some countries, foreign exchange deposits are not allowed, and in Argentina's case, those are too risky. The central bank, the government, can confiscate and probably has been confiscating those dollars illegally. Again, that's just my own opinion, basing off what the news and what I'm hearing on Twitter and from news writers over there in Argentina. That's not Cointelegraph's official view. Well, can't the fintechs solve the issue? Like, can't they just use PayPal or Apple Pay that enable international transactions? Yes and no, because the costs, especially if you're doing FX changes from Argentinian pesos to US dollars and vice versa, those costs are too high, and the government usually tax those transfers or ensure there are hard limits. Last I remember, the limits for locals in Argentina to buy US dollars was like $200, $100 per month. Stablecoins, on the other hand, are a much better solution, as users are allowed to store their digital dollars and euros by themselves, convert to foreign currencies, and transact freely. All they need to do is find a peer-to-peer sales or exchange to convert their local pesos to stablecoins. So, cryptocurrency fans will likely come out disappointed after speaking to people living in weak economic areas, including El Salvador. For them, the safety of the dollar comes from the apparent lack of inflation, as their own currency devalues in dollars year by year. That is why it doesn't matter whether the Lightning Network offers instant transactions for Bitcoin fractions, the Satoshis, or if XRP has bought a partnership with MoneyGram. Those cryptocurrencies have way too much volatility for those who are seeking peace of mind. It simply does not work for them. Still, in Argentina's case, stablecoins might work as a Trojan horse to showcase cryptocurrencies' benefits for the population. Once they see its value, maybe some of those will understand the importance of censorship resistance and perceive how the US dollar, its value, has also declined by 25% over the last 4 years due to inflation. On to the next topic. This time we'll talk about the Federal Deposit Insurance Corporation, FDIC. Reuters reports big US banks to pay billions to replenish the failure fund. The bank regulator will apply a special assessment fee of 0.125% to uninsured deposits of lenders in excess of $5 billion. We've all heard how the FDIC recently took control of some failed banks, including Signature, Silicon Valley, and First Republic. Although the US Treasury created special credit lines and helped out by taking junk bonds out of the market in exchange for US Treasuries at face value, a big hole has been left at the FDIC, a big loss. Now, this privately owned institution is informing the 113 largest banks in the US that they will have to cover the $16 billion loss. Lenders whose assets surpass $50 billion will face extra fees for the next couple of years. The regulator estimated that if the entire amount was paid in a single quarter, it would represent 18% of the sector's earnings. So what's the lesson here? And what's the impact for the financial sector? Well, first of all, there's no free lunch. Remember, a consortium of 11 banks, private banks, were forced to inject $30 billion in the First Republic Bank, merely 6 weeks before its collapse. The FDIC might be a good advertising strategy, but in fact, its $120 billion in assets can barely cover 0.7% of the commercial bank's deposits. Moreover, there's the cascading effect, as the remaining institutions are obligated to cover the losses from the failed banks. So the first movement from the banking crisis has been withdrawals from these financial institutions, but the money has been moved mostly to money market funds. The advantage, those funds usually pay close to the Fed interest rate of 5%, and each fund is a separate company, a separate entity, so totally unrelated to the managing financial institution in risk terms, so it's much more safe for investors. So is that it? The banking crisis, which everyone expected that could weaken the US dollar and maybe catapult cryptocurrencies to a much higher price level, happened to be a non-event? No. Firstly, because we've seen only a handful of mid-cap banks failing, but more importantly, because the interest rates remain high. Right now, investors are comfortably sitting in fixed income strategies. Eventually, the Federal Reserve will have to revert those high interest rates, either because the economy is in a deep recession or due to the excessive interest rate payments from the government's $31.5 trillion debt. Where will that money go once the high interest rates are gone? No one knows, but it certainly plays in favor of risk assets, including Bitcoin. On our third and final topic, we'll discuss the Bank of England recent economic forecast changes. Bank of England hikes rates by 25 basis points, no longer sees recession. So England's central bank raised its interest rate to 4.5% yesterday. and updated the forecast, stating that no longer expects a recession in 2023. Keep in mind the region's latest inflation data has shown a 10% increase in March year over year, so odds are the families and business are struggling with the surging costs. They are now pinning the improved near-term outlook to the falling energy costs and are now expecting the GDP, the gross domestic product, to remain flat for the first half of 2023 and grow almost 1% by mid-2024. But what does that mean? Is England really gonna avoid the global recession that is widely anticipated? In my opinion, there's two things that are happening that are giving the false impressions that the economies are in good shape. Number one, both the housing markets and the stock market are near their all-time high. Maybe that's because of the trillions and trillions of dollars injected by central banks to avoid the crisis over the past 2 years. But in investors' perspective, everyone is filthy rich. Number two, companies rather sell inventories at a loss than suffering from declining sales. The first measure is layoffs, which have barely scraped the surface. The second is failing to meet their obligations, which is showing its first signs in the commercial real estate market. In short, we are too early in the crisis. The lesson for Bitcoin and crypto investors? Well, if you enter the space to protect yourself from the crazy central bank planning system and their failed currencies, hold on tight. Those next few months might sound that the economies are in better shape than reality. Just hang on tight. Well, that's it for today. Remember to like and subscribe the new Cointelegraph Markets and Research YouTube channel.